Hi everybody, it's AJ speaking. Volvo, the car company owned by Chinese company Geely, reported this morning 2Q results. The share price jumped over 8%, as you can see in this chart. Trading is still ongoing in Europe, but the reason the stock jumped was not because of the Q2 results, which were quite bad, as you will see in a moment. But before we dive into the details, it's important to zoom out a little bit. Despite this massive jump, the stock is down almost 20% just year to date. But whenever you do this type of analysis, you need to make sure you keep the news items in mind, and especially when they happened. So the bad Q2 was basically pre-announced. Pre-announced means it was announced before the Q2 was released. And you can see this in this timetable. So for this reason, there wasn't a big surprise in terms of the actual numbers that were reported. So the call and so after release of the numbers, management gave a call, and that caused the spike in the share price and not the numbers. So what was the call about? This is what you see in these excerpts from the management presentation. There's a bunch of stuff to go through, but I think we can just focus on the things I highlighted in red, because these are the things I think investors are most interested in. So number one, so here in this first point, Volvo talks about SEK 18 billion cost and cash plan fully on track. This means there's a cost saving of 18 billion SEK. For anyone who doesn't know SEK, myself included, this is $1.7 billion. So it's quite a big saving, and this was a significant driver of the spike in the share price this morning. Then also, I think this very near-term roadmap of new vehicles, I think also is quite supportive, because typically when new vehicles launch, they see a boost in sales. Then also down here, these items regarding China, that there's a vehicle launch locally produced just around the corner, is positive. Then also the EX30 now being produced in Ghent. And then, of course, the headcount reduction market almost always responds positively to layoffs, and Volvo announced 3,000 layoffs. And importantly, this will affect Volvo's financial already from the fourth quarter of this year. So for all these reasons, the market very quickly moved on from all the one-off negative items. And the one-off items mostly comprised two things. There was very large intangibles impairment. It's a non-cash item. So this doesn't cause a cash outflow. It just makes a P&L number look terrible in this case. And then the second item comprised of restructuring charges. These two mostly carry a cash outflow. So with that, let's dive into the numbers. So here, first of all, total revenue development. So this is not affected by these one-off items, except for certain vehicle delays. But I wouldn't consider these one-off items, because that's just part of the business model of an automaker. And you can see in the first quarter, total revenue was down 7.8% compared to the same quarter last year to 8.7 billion. On the second slide, you see wholesale vehicle sales. So wholesales is the number of vehicles sold that actually matters for total revenue recognition. So that sales mostly to dealerships in Volvo's case. So those sales, they came down almost 13% year on year to just under 180,000 vehicles in the second quarter of 2025. On this third slide, you can see retail vehicle sales. So retail is actually sales to end customers. So these are sales that dealerships report back to Volvo. And you can see that those sales actually slightly higher than the sales used for accounting recognition. So that's a good thing for Volvo. This also means that the global inventory was slightly reducing, but those sales are also down nearly 12% year on year. So then we look at gross profit. So gross profit is the first item that is affected by these very large one-time charges. In Q2, you can see gross profit as a result dropped to just over 1.2 billion in the second quarter. This is down 46% year on year. But again, this was one-off driven. But therefore, I expect a strong recovery in the third quarter. Then gross margin, obviously the same thing. Gross margin came down year on year from 22.8%, which was actually Volvo's all-time high, to 17.7%, excluding these one-time charges. But the reported gross margin was 13.5%, which is very low. 13.5 is generally too low for any automaker to operate sustainably, because 13.5% gross margin does not provide enough fixed cost absorption. Only once an automaker gets to at least 15%, they have a chance of becoming operationally sustainable. This is then a slide that shows you operating profit. Operating profit dropped to operating loss of 924 million. Again, this is significantly driven by a one-off non-cash impairment in the amount of 1.1 billion. Otherwise, Volvo would have been moderately profitable. The main driver of the operating loss was a huge impairment charge that was recognized within R&D expenses. This blew up R&D expenses to 1.2 billion in the quarter. But if you exclude that one-time charge, R&D expense would have been 516 million, which, however, is still up 18% year on year. Or put differently, if you adjust for the one-time charges, Q2 2025 would have been Volvo's all-time highest R&D spend quarter. But remember, Volvo's revenue went down, so their R&D efficiency in terms of R&D as a percent of revenue went down as a result. So next, administrative expenses increased 5.4%. In the second quarter, however, there was some restructuring charges included, so the run rate number would be slightly lower. Year to date, Volvo's admin base is still down 1%. Once Q4 in Q4, I expect that there will be a meaningfully lower level of admin expenses due to the headcount reduction. Selling expenses as well decreased in the quarter 3.5% year on year to 608 million. And after the first 6 months in 2025, selling expenses are down to 1.1 billion, or 3% lower compared to the same period last year. Then we look at the operating margin. You can see that the reported operating margin was a negative 10.6%, caused by these one-time charges. If you adjust for that, you get to a positive 3.1%. However, even at 3.1%, Volvo's profitability is still super low. But you can see in this long-term trend, so this goes back 3.5 years, you can see rarely did Volvo generate attractive returns. The norm for Volvo appears to be somewhere near or just below 5%. Just a quick look at profit before tax. Here again, we have a significant loss of 934 million driven by one-time items. This is shareholders' net income. Similar story. The loss is for shareholders 697 million. And then we get to cash flow. Cash flow is much more interesting. Cash flow, since it's a pure cash perspective, excludes these one-time non-cash charges and gives us a much better picture of how Volvo actually performed in the second quarter. And you can see in this slide, Volvo was cash flow positive, generated 595 million in cash flow. This comes after a cash loss of 1.1 billion in the first quarter, which after first 6 months in 2025 results in a still negative free cash flow of 515 million. And interesting observation, since October 2021, when Volvo was IPO'd by the current owner Geely, Chinese automaker, drumroll, Volvo's cumulative total free cash flow amounts to $10 million. Yes, you heard this right, $10 million, not billion, $10 million. So given the size of Volvo, it means Volvo is just break even in terms of cash flow generation. This is already a first key finding when you try to assess Volvo. This also explains why Volvo, despite its relatively large size, is only valued at just under $6 billion right now, because nothing drives valuation more than strong free cash flow. So now let's analyze how Volvo actually generated 595 million in free cash flow. And over here you see the two main components. Number one, there's operating cash flow, and then you take out capital expenditures from operating cash flow. The result is free cash flow. So let's first look at the deductions of capital expenditures. Capital expenditures increased moderately year on year, 3% in the second quarter to just under 1.1 billion. After the first 6 months, Volvo's 2025 capex is down by 4% to just under $2 billion. So this already tells us that the positive free cash flow was not the result by Volvo cutting back on capex. This conclusion is then confirmed when we look at this chart. This shows you operating cash flow. So operating cash flow was just under 1.7 billion in the second quarter, which was actually Volvo's third strongest operating cash flow quarter ever reported. So, but now we need to find out, okay, how did they generate this operating cash flow? What were the key components or key drivers? So this is what this chart shows you. This is basically a decomposition of the operating cash flow. And you see over here on the right-hand side, the net result of all these components. It's the 1.7 billion that I just mentioned. So there are 6 components that matter. Number one, on the far left, you see adjustments for other non-cash items. So these are all these impairment charges, etc., that Volvo took in the second quarter. They make up the biggest positive contribution because, again, there was no cash out, so that this is an add back. Then D&A is depreciation and amortization. This is also just an accounting charge. There's no cash out because D&A comes from things you spend cash on typically a long time ago, and you just write them off over time, and this write-off charge is deducted from your operating income. And in operating cash flow, this results in as an add back of this, let's call it notional amount. So this is also fine. But then we go to a certain third item, which added positively 463 million, is a decrease in receivables. So a decrease in receivables means the amounts people owe Volvo decreased. And in a company like Volvo, this will be mostly dealerships. So Volvo probably called up the biggest dealerships and told them they need to reduce their bills with Volvo and need to transfer money. This is what you see in this item. But this is a low quality item, and I will explain in a moment why this is a low quality item. So let's look at the fourth item, which is an increase in contract liabilities to customers. So this is basically where Volvo received a prepayment before they fulfilled their performance obligation. It's kind of interest-free debt. So this is also a cash in. But again, this is also a low quality item, and explain in a second why. And then we go to the fifth item that contributed positively to operating cash flow, which was an inventory decrease. So an inventory decrease is often misunderstood in an automaker like Volvo. Volvo has what's called an wholesale model. So Volvo sells mostly to dealerships, and whether the cars on the dealer's lot move or not has no impact on Volvo's balance sheet, Volvo's inventory therefore. So the inventory that you see here is mostly raw materials that Volvo bought, components, unfinished goods, and a relatively small amount of cars that wasn't shipped yet to any kind of dealership. So the new Volvos that you see sitting around on dealer lots, they are not part of that inventory. However, that's a completely different story for companies that do not use a wholesale model, and a good example would be Tesla, but that's for another video. And then we skip other net because it's not really a needle mover, and we can get to the final item, which is operating income. So operating income was negative, but this number contained all these notional charges, these impairments, etc. And that's why you add all these items back. And that's why the net amount of all of that is then your operating cash flow. I'm skipping here a few things, otherwise this video would become too long. But this is really accounting 101, and so the net result is our 1.7 billion operating cash flow. And now let's discuss why these items here highlighted in this box that add up to just over 1 billion are low quality. It comes down to the following question: is this an item that can be sustained over long periods? So let's look at it one by one. The first one, a decrease in receivables. Of course not. Once the balance of receivables has reached zero, you cannot reduce it further. So this item would go to zero at some point in the future if you kept this up. Increasing contract liabilities to customers. Yes, this item with increasing business scale, etc. If you grow, you can keep growing for some time, and BYD is a good example of that. But once you reach a steady state, this item also goes to zero, and therefore it's also not an item you can project for a long time. And the third one, inventory decrease, is the same thing. You cannot decrease your raw materials, components, unfinished goods to zero. You can theoretically reduce it to zero, but then it's over. And this item goes also to zero, because ultimately this is about a change. And once you reduce something to zero, you cannot generate a positive change anymore, unless you somehow manage to have negative raw material or negative components and negative unfinished goods. So it's a big picture. If you think about these items, ask yourself, is this something that could, in theory, go on for perpetuity? If the answer is probably not, then there's a good chance that in the real world this is also likely not sustainable. And therefore you can objectively classify it as a low quality item. So, but what's the point of all of that? The point is to figure out, okay, what is the true or a better proxy for real operating cash flow generation? And this is this number up here. It's just over 600 million for the second quarter. And it's simply the reported operating cash flow less these low quality items. But then what does this mean? To answer that, we need to jump back real quick to capital expenditures, because capital expenditures is basically what you need to spend to keep the business going, develop new products, etc. blah blah. And Volvo spent just under 1.1 billion. So the proxy for real operating cash flow generation was only just over 600 million. So that means the underlying operating cash flow wasn't enough to actually fund the business. So that's the key takeaway here. But the other thing to keep in mind, market often pays quite little attention to cash flow, and they look mostly at profitability numbers until it gets too bad. And by bad I mean when the capital base gets eroded. And that's why we need to look at the cash balance of the company. And by the way, when you look at cash balance, you also always want to include all types of liquid assets. So not only the disclosed cash balance, but also short-term investments and any other type of highly liquid instrument. Otherwise, you run the risk of underreporting the company's cash position. In theory, these companies also have undrawn credit facilities with lenders, but once an automaker has to significantly use that facility, it's already too late and the market is selling off the company hard. So that's why I typically don't include these credit facilities in my analysis. Also, when the S hits the fan, it's not 100% guaranteed that credit facility might be around. And people who lived through the financial crisis know what I'm talking about. So let's look at the cash balance. At the end of the second quarter, so this is as of end of June 2025, Volvo reported 5.2 billion, which is nicely up from just under 4.4 billion end of March. The key drivers were number one, the free cash flow that we just looked at. But remember, about 1 billion was low quality items. So stripping out these low quality, non-sustainable items, there would have been a negative free cash flow. So cash would have gone down. And this is exactly why Volvo, despite the free cash flow, decided to raise just under $500 million in additional debt. By the way, I totally predicted they would raise in Q2 more debt. Just check out the same slide in my last Volvo presentation. So we're now at the end of this a quick review right after Volvo's Q2 financials release and management presentation. In this presentation, I will not give non-trading advice as to whether it's a good idea to short this company or take a position. I'll be sharing in the future a forecast, and in that analysis I will be sharing my views. What's the opportunity here? But you can see by this 8% share price reaction, Volvo is volatile, and volatility creates opportunities. And this makes this company interesting, especially when it feels like the rest of the market is entirely focused on AI, and maybe such opportunities get too little attention. Here a quick side note, this is the implied forward PE of the S&P 500 right now. This is as of end of June. This was at 22 times. This would now be slightly over 22 times. You can see by historic measures where the market is quite expensive right now. And even if you have some really great long positions, my opinion, you should always have some poor stocks in your portfolio that you short, because when the market sells off and there's at some point always a sell-off, you will really appreciate having some shorts that will print for you when your longs go down. And just to really bring home my point, so here I'm pulling up a post I made in February 11, where I basically warned about Volvo. Volvo's finances appear to be nearly maxed out and exposes Volvo to elevated downside risks. In some other posts, I recommended, again, not trading advice, to basically building a short. At time of this post, Volvo traded at over 21 SEK per share, offered plenty of opportunity to average up easily into 23 SEK per share. And then subsequently, after only a couple of weeks, when we had the April sell-off, offered tons of opportunity to exit in the 16 or 17 SEK range for a nice 30% return within just 1 or 2 months. And even if you held until today, and even after this massive 8% spike, you still would be sitting at least 10 or 15% returns. So that's the end of this quick review of Volvo's financials. If you find this type of investment research helpful, I recommend follow me on X, or better, subscribe to me on X, because I share a ton of research. It's all numbers based. There's no BS or speculation pulled out of thin air. This approach enabled me to beat the S&P 500 for over 20 years, since 2004, before I sucked as an investor. But as time goes on, I improved my game, and so can you. With that, have a great week. Bye.